The Simple Path to Wealth by J.L.Collins. Two childhood friends choose different paths. One becomes a humble monk, while the other rises to power as a wealthy minister to the king. Upon reuniting, the minister pities the monk's simple lifestyle and says, "If you learned to serve the king, you wouldn't have to live on rice and beans." The monk replies, "If you learned to live on rice and beans, you wouldn't have to serve the king." In this story, it's the monk who shows true independence, while the minister remains tied to his need for wealth. In the modern world, to achieve independence, one must have something called FU money. This refers to saving and investing enough money to generate passive income. FU money gives you the freedom to make life decisions, such as the ability to say no, switch jobs, or travel. Financial independence isn't about owning material things. It's about living freely and on your own terms. Is it possible for you to become financially independent? In other words, can you have $1 million in your bank account? To answer this, along with other interesting questions like how you can become a stock market expert just by watching this video, let's first learn some important stock market terms. If you already understand these terms, feel free to skip ahead. Imagine Nike is like a big pizza. The whole pizza represents the company's stock. When Nike wants to sell part of the company, they cut the pizza into slices, and those slices are called shares. So, if Nike has 1 billion slices or shares and you buy 10 slices, you now own 10 shares of Nike stock. In short, stock equals the whole pizza. Shares equal the slices you can buy. Now let's say you have $5,000 and want to invest in the stock market. You could buy shares of 1 or 2 companies, but this carries high risk. If those companies lose value, your investment could drop significantly. But what if you could invest your $5,000 across 500 or even 5,000 companies? This is where funds come in. Funds pool the money of many investors together. When you invest in a fund, your money is spread across different companies, reducing risk. If one company loses value, it won't impact your entire investment as much because you're diversified. There are 2 main types of funds. Number 1 is actively managed mutual fund. This type of fund has managers who actively pick which stocks to buy and sell based on research. They regularly adjust the stocks in the fund. Number 2 is index fund. An index fund doesn't have managers making decisions. Instead, it invests in a fixed list or index of companies, like the S&P 500, which includes the top 500 US companies. The goal of an index fund is to match the market's performance, not beat it. For example, the Vanguard 500 Index Fund is an index fund that tracks the performance of the S&P 500, while other index funds might track all US companies. If these companies do well, the fund will also do well. Now let's answer the question, will you become rich? The answer to our question is both yes and no. It's possible for middle-class wage earners to retire as millionaires. For example, investing just $150 monthly in the Vanguard 500 Index Fund from 1975 to 2015 would have grown to over $1 million. However, it can also be difficult, as it depends heavily on your expenses. The author provides a formula for financial independence, with the first key variable being spend less than you earn. Consider this $100 bill. Different people have different approaches to it. You could spend it immediately, which reflects a poor mindset. You could invest it and spend the returns, which reflects a middle-class mindset. Or you could reinvest the earnings for long-term growth, which leads to wealth. Take Mike Tyson, for example. Despite earning $300 million, he ended up bankrupt because he viewed money as something to spend, not something to grow. When you spend money, not only is that money gone, but so are the future earnings it could have generated. Imagine 2 versions of Tom, Wise Tom and Foolish Tom. Both start with $20,000. Foolish Tom decides to buy a car with his $20,000. After 3 years, the car has depreciated, and it's now worth only $16,000. Wise Tom, on the other hand, invests his $20,000 in an index fund that earns an average annual return of 8%, compounding yearly. After 3 years, Wise Tom's investment has grown, and it's now worth around $25,000. This demonstrates opportunity cost. While Foolish Tom's car is now worth only $16,000, Wise Tom has $25,000. The opportunity cost of buying the car was the potential gain foolish Tom could have made by investing, just like wise Tom did. Over 10 years, this opportunity cost would total $43,000. Opportunity cost is the price of the missed opportunity to grow your money when you spend it on something else. The second variable in the financial freedom formula is avoid debt. Debt has become normalized in society, allowing people to afford expensive items like cars and education, but at the cost of financial freedom. If you're in debt, here's what to do. If the interest rate is less than 3%, pay it off slowly and invest your money instead. If it's between 3 to 5%, choose either paying off the debt or investing, depending on your comfort level. If the rate is over 5%, prioritize paying it off as soon as possible. The final part of the formula is to invest. Investing your money is simple, yet it is often complicated by mutual fund managers. The author suggests choosing index funds over actively managed mutual funds. Throughout the history of the United States stock market, it is rare for actively managed funds to outperform index funds. This is mainly because actively managed funds have managers who charge fees, and the frequent buying and selling of stocks incur taxes, further reducing earnings. Between 1980 and 2005, actively managed mutual funds averaged just 10%, while index funds averaged 12.3%. A $10,000 investment in an index fund would grow to $170,800, compared to $98,200 in an actively managed mutual fund. This 57% difference highlights the importance of minimizing costs by choosing index funds. When you invest in a stock, you're not just dealing with rising and falling numbers, you're investing in a real business. For example, if you buy shares of Microsoft, you become a part owner of the company. If Microsoft is profitable over the next 5 years, you will earn a profit as well. Whether at $56 per share or $52 per share, you still own the same 186.32 shares of VTSAX, meaning you own a piece of virtually every publicly traded company in the US. However, there is always a risk involved in investing, including potential market crashes, such as that of 1929. Even cash buried in the backyard will lose value over time due to inflation. There are two types of investment stages. Number one is wealth accumulation. The wealth accumulation portfolio is suitable for those who can take risks, particularly individuals who are actively working. This portfolio is designed for long-term wealth building with a focus on simplicity. The author recommends this approach for his 24-year-old daughter. The strategy involves continuously adding to the portfolio and allowing it to grow over time. He advises investing entirely in VTSAX, which represents ownership in about 4,000 U.S. companies. Owning VTSAX means investing in a wide range of companies, thereby minimizing risk through diversification. He suggests a 100% allocation in stocks within index funds, essentially putting all your eggs in one basket. Number two is wealth preservation. Before discussing the wealth preservation portfolio, let's briefly cover bonds. Bonds are loans to companies or governments. However, bonds carry various risks, particularly related to inflation, as their value decreases with rising inflation. Also, rising interest rates can decrease bond values. In the wealth preservation portfolio, the focus is on safety. This portfolio is tailored for semi-retired individuals, such as the author and his wife. It prioritizes preserving wealth while still allowing for some growth. The author suggests allocating 75% to VTSAX, 20% to bonds, and 5% to liquid cash for immediate needs. The author suggests avoiding short-term investments. Even at 60, you may have several decades of life ahead, or you might want to leave wealth for family or charity. This leads to the independence formula from the book. Spend less than you earn, invest the surplus, and avoid debt. Now, in the last minute of the video, let's answer some key questions. Question number 1. How can you become a stock market guru? Make extreme predictions, record them, and wait. Eventually, one unlikely prediction will be right, then issue a press release. Question number 2. How much should you withdraw in retirement? Withdrawing less than 4% annually is a safe strategy, but withdrawing more than 7% significantly increases the risk of running out of money. Question number 3. When will you be financially independent? You'll reach financial independence when you can live on 4% of your investments annually.